The FTSE Global All Cap, the FTSE All World, and the Lifestrategy funds are all global funds and all great ways to invest for the long term. But which global fund is best? That's what we're going to be discussing in this video, taking a look at the fees, what they invest into, their performance over time, and a few other criteria along the way as well. Two disclaimers before we start getting into it straight away. Number one, ultimately, they're all great ways to invest for the long term and all great options. The most important thing is to literally pick one, set up an automatic monthly investment, and just get started. Number two, I personally stick to the FTSE Global All Cap. That's what I've been using for nearly 5 years now. So I'm a bit biased towards that one, but I want to try and be as objective as possible when discussing these three different funds. So let's get straight into it. And number one is the type of instrument they actually are. And all three are different instruments. The FTSE Global All Cap, which I'm going to refer to as the All Cap, is an index mutual fund. The FTSE All World, which I will be referring to as the All World, is an index ETF. And the Lifestrategy funds are essentially funds of funds. So there's multiple different funds that make up the Lifestrategy funds. And for this video, one I'm going to be focusing on is LS100 because that's 100% in equities, 100% in stocks. They do also offer other versions like LS80, which is 80% stocks, 20% bonds. I'm going to be assuming you're in the wealth accumulation phase, trying to grow your wealth over the decades. So you probably want to be 100% in equities. So I'm going to be comparing the All Cap, the All World, and the LS100. So they're all different types of instruments, which, I mean, I could talk about this for 10 minutes, although it'd probably be pretty boring. It's just something to be aware of because that leads into number two, which is accessibility. Generally speaking, ETFs are available on more platforms. So the All World is an ETF, and the chances are if the platform you use offers ETFs, they will almost certainly offer the All World, as is, I imagine, as probably the most popular global ETF out there. The All Cap and the LS funds are available on fewer platforms because of the type of instrument they are, being, essentially an index mutual fund and a fund of funds. They are really only available, from what I've seen, on the more older school traditional platforms like Vanguard, Hargreaves Lansdown, and AJ Bell. They're not as accessible because they're not on your trading 212s or your free trades, for example. Whereas the All World is pretty much available on every platform if they offer ETFs. If that ultimately is the only option available to you, then of course that'll be the only one to go for, but it's still a good option. So just because it's the only one, don't think it's bad. It's still a good option, as we're going to come onto when we look through the different criteria. Number three, quick thing to point out here, an important point, is all three options offer an income and an accumulation version. Income pays out dividends as cash. Accumulation reinvests the dividend back into the fund. If you're building your wealth, you want to be using the accumulation version to reinvest the dividends and grow and compound your wealth quicker over time. Now, let's get into the more meat of the comparisons. And number four, we're going to be talking about fees. And to be honest, there's not a huge amount to say here. The All Cap has an ongoing charge of 0.23%, whereas the other two funds have ongoing charges of 0.22%. You don't actually see this cash leaving your account. Is taken from the net asset value of the fund. So you don't, see money coming out, but it's still being taken. Don't worry. Of course, if they have a chance to charge us fees, they definitely will.
Oh, sorry.
But if we dig a little bit deeper and look at Vanguard's full cost and charges, there are some slight differences. So the FTSE Global All Cap, once you factor in the transaction costs, the total cost is 0.29%. The All World is 0.25%, and the LS100 is 0.24%. So based on that, the All Cap is actually about 20% dearer compared to the LS100. Although in reality, I can show you a quick compound interest calculation over the long term that ultimately has minimal impact. If we assume we're investing for 30 years, 500 quid a month, and we earn 7%, if we take off the FTSE Global All Cap's 0.29% ongoing fee and transaction cost total, the 0.29%, we're left with a 6.71% annual return over the 30 years. The projection gives £576,000 over the 30 years. If we now change the rate of return, assuming we're using the LS100, where the total fee is only 0.24%, then the interest rate or the rate of return we earn over that 30-year period is 6.76%. If we then calculate this, we can see we're left with £581,000 over the 30 years. So only £5,000 more. Of course, £5,000 is a lot of money, but if you look at £5,000 in terms of the relativeness between 576k and 581k, it's pretty much immaterial, I would say. Which essentially the point here is that when fees are so rock bottom, like all these free funds are, incredibly cheap for what you're getting, then the actual projection over the long term is almost identical. The big difference is if you're paying, say, 1% for a fund and you could be paying 0.25%, that 0.75 gap is going to save you tens of thousands of pounds, if not hundreds of thousands of pounds over the long term, depending on how much you're investing. But yeah, all these free funds, what I'm trying to say, are incredibly cheap for what you're getting. Now let's actually talk about the funds and particularly what they actually invest into and the portfolio data. So the FTSE Global All Cap tracks the All Cap index, and that currently has over 7,000 stocks in that one index. The FTSE All World, as you can probably have guessed it, tracks the All World index, which has over 3,600 stocks inside of it. And with the LS100, it's a bit more difficult to work out because, as I mentioned, it's a fund of funds. So if you want to, you could look into all the individual funds and work it out. I'm just going to say it invests into also thousands of stocks around the world in different proportions. The main difference here though is the All Cap and the All World invest proportionally in relation to what the stocks make up of the global economy. So for example, let's looking at the portfolio data quickly. For the All Cap, 3.62% is made up by Apple. So in that fund, Apple proportionally makes up 3.62%, because that is how much they make up of the global stock market. So it's sort of proportionally weighted, meaning it's sort of efficient and it allocates the money to the largest companies in that same amount, if that makes sense. It's quite hard to explain. The All World is the same, whereas with the Lifestrategy funds, Vanguard have determined what percentages to invest into different parts of the global economy in, and this has resulted in a home bias. The UK only makes up roughly 4% of the global stock market, but in the Lifestrategy funds, UK stocks make up roughly 19%. So they're 4 times overweight. And that is the main difference between the All Cap and All World and the LS100. And that's ultimately why I prefer the All Cap and the All World. So that's probably the main thing to be aware of. But as you can see, we're on the FTSE Global All Cap page. And what I'm gonna do is just quickly scroll through each fund and essentially show you what we're looking at. So the All Cap, as I mentioned, has over 7,000 different stocks. In terms of its region exposure, it's mainly invested into North America. And once again, if we scroll down, the main country is the United States, which is 59.2%. The reason why is because the US stock market makes up roughly 59.2% of the global stock market. So it invests proportionally into the various countries and industries and companies in proportion to what they make up of the global stock market. That is confusing, but I hope it makes sense. So you can see the UK here only makes up 4%. And if we scroll further down, there are 7,000 companies that obviously split across these various industries. So it's mainly in tech, which is over 21%, followed by consumer, discretionary, and in industrials. And in the top holdings, no surprises, all the big sort of FANG tech stocks. You got Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Facebook. Yeah, no surprises there. We then go into the All World, looking at the portfolio data. You can see there's only half the number of stocks here, around 3,600. The reason why, and this is sort of the main big difference, the main difference with the LS funds is the home bias. The main difference with the All World compared to the All Cap is that the All World doesn't invest into small cap stocks. It only invests into large and medium sized companies or large and medium cap stocks. Whereas the All Cap, as the name suggests, all cap, all capitalization, all market caps, the All Cap invests into large, medium and small sized companies. And that essentially results in the All Cap having double the amount of stocks compared to the All World. As we're going to come on to see in terms of performance, the performance is literally identical, it's negligible. The reason being because sometimes small caps outperform, sometimes they underperform. Generally there's sort of a reversion to the mean over the long term. But yeah, the main difference between the all cap and the all world is the all cap invests into all companies, whereas the all world is just large and medium sized companies. But that was a lot of information. Scrolling down, as you can see, once again, North America is the largest region. Once again, the United States is roughly 59%, the UK is roughly 4%, because that's what they actually make up of the global stock market. The largest sectors are going to be probably, tech once again at 22%. As you can see here now, the order is slightly different. So financials, consumer discretionary and industrials are all around 13-14%. It's slightly different, and that's essentially because different indexes will be allocated to sort of different stocks. But if you sort of look at the fuller picture, it's largely the same between the all cap and the all world. And if you then scroll down again, the holdings, all the same largest holdings once again, I think in the identical same order. So all cap, all world, very, very similar, almost identical performance as we're going to see. The main difference is just the all cap invests into small cap stocks as well. The Lifestrategy fund is then a bit harder to work out because, as I said, it's made up of many funds. So the main fund it has here is the US Equity Index Fund, which is 20%, and that essentially is the total US stock market. I think that's got about 3,500 stocks in from memory. Just checked it and it's 3,883, so that's close enough. It's then got the FTSE UK All Share, so the total UK stock market. Now that's 20%, and that's 4 times overweight, or more, nearly 5 times overweight, sorry, actually, because the UK only makes up 4% in the all world and all cap, but it makes up nearly 20%, and that's because Vanguard has sort of artificially set these percentages at what they want them to be. I guess it sort of makes sense. So I'm not mentioning it yet because it is a bit more complicated, but with FX movements, generally speaking, investors like investing more in their home companies because they earn more of their money in the home currency. So for us being pounds, and that means they're less subject to FX rate movements. Now, it's a big topic, I'm not gonna get into it, but over the long term, generally speaking, FX rate movements, although they can impact your portfolio in the short term, over the long term, there's sort of a minimal impact. So I'm not gonna get into that here, but just something to be aware of. Maybe go away and do some further reading on that afterwards, or I can even make a whole video on how FX can affect your portfolio. If we look at the rest, we once again have then ex-UK Equity Index Fund, the S&P 500. So what you're essentially gonna get here is a global index fund that's similar to the all cap and all world, but with a home bias, meaning there's more UK stocks than there should be based on how much UK stocks make up of the total stock market. Okay, that was the meatiest bit of the video done. Now let's actually take a look at the performance over the last 10 years. So the last fund to start was the all cap, which came about at the end of 2016. So if I now filter all these charts to make them from sort of roughly 2016 onwards, you can see the performance is literally identical, particularly with the FTSE All World and the all cap. The resemblance is, almost exactly the same over that 5-year period. If we then also show the LS fund as well, the LS 100, it's once again a bit more steady because essentially they're investing more into UK stocks, whereas US stocks generally have swung more wildly because they're the large tech stocks and they're more volatile. But even though there's less sort of wild swings, if you look at the projection over time, it's once again very similar. So what I'm trying to get across here with these 3 funds, they're all great, they're all similar, and they all give largely similar performance. Which one's going to perform the best over the long term? No idea, no one knows. One risk with the LS 100 is because of the home bias. If UK stocks do underperform, then you're going to feel it more with the LS 100 because there's 20% UK stocks rather than 4%. But then once again, if the UK performs amazingly well, who knows? Then this fund is going to probably do better than the other 2. So it's one of those things, you got to go with what you're most comfortable with and what you prefer. Also worth saying, the Lifestrategy range also does offer LS80, LS60. So if you are a more risk averse investor and want some bonds, you could use the LS80, and rather than having like a stock fund and a bond fund, you can just have one LS60 fund or one LS80 fund, and it does make it more convenient and simple from that point of view. The last thing I want to look at now is the dividends that the funds pay, and would you guess they're all once again very similar. The all cap pays 1.74%, the All World pays 1.97%, and the LS 100 pays 1.96%. So the All Cap is slightly less, about 0.2% less than the other two funds, and I think that ultimately is because it invests into more companies, a lot of small cap stocks, particularly around 3,500, and most of them, if any, will pay dividends, which is why it's slightly less. That essentially is a comparison of the three global funds, the All Cap, the All World, and the LS 100. Ultimately, I hope that's been helpful, and hopefully it can help you to make up your mind. I guess for me personally, and sort of my point of view, the LS funds have that home bias, which is why I don't like them. The All World doesn't include small cap stocks. As I sort of mentioned, they sometimes overperform, but essentially I would rather be as diversified as possible, which is why I use the All Cap, because that includes the All World plus small cap stocks. Whew. Yeah, that wraps up this one on which global fund is best. Please leave a comment down below if you found this helpful, and importantly, which fund you use. I think the majority of people do use the All World, just because going back to right at the start of the video, that's the fund that's most accessible and on most platforms, so it makes sense. But yeah, let me know what you use in the comments below. Thank you for watching, and I'll see you in the next one.